Hi everyone, it's Dan here. Have you ever wondered whether a stock you're interested in is selling at a fair price? In this video, we're going to use two of the most fundamental ratios to help you figure that out, the PE ratio and the PEG ratio. We'll discuss how you can use these ratios to help you value companies such as Apple and Intel. I'll cover four main points. Number one, what are PE ratios and how do you use them? Number two, trailing versus forward PE ratios. Number three, limitations of PE ratios. And finally, number four, PEG ratios. If you're new to the channel, my name is Dan, and the purpose of this channel is to help you build wealth through saving and investing. All right, let's jump into it. First topic, what are PE ratios? Well, the PE ratio stands for price to earnings ratio. So the formula is the price of the stock divided by the earnings per share, which is the profit of the company. So what this ratio tells you is how much you are paying for a given level of earnings. The lower, the better. So if a company has a PE ratio of 8, you're paying $8 for a company that makes you $1 a year. That's much better than a different company with a PE ratio of 30, where you're paying $30 for something that earns you $1 a year. Now, comparing PE ratios between two companies is not always that simple. There's a few factors which really affect PE ratios. One of them is risk. So riskier companies are generally going to have lower PE ratios. This price discount reflects the greater risk of these companies. A second factor which makes it hard to compare PE ratios across different companies is growth. If a company is in a growth phase, they may have a PE ratio as high as 100, which makes them look like a terrible deal on paper. But if their earnings are growing very fast, they may still be a great investment. For these reasons, it's usually best to compare companies' PE ratios within the same industry. Many companies' earnings are not stable from year to year. So when we look at PE ratios, they can fluctuate wildly. One way we can overcome this is to look at trailing and forward PE ratios. The trailing PE ratio means we take today's price and divide it by the most recent earnings we have. So that may be earnings from their last annual report, or it may be a trailing 12-month measure of earnings, which means the last 4 quarters of earnings. There is another approach though, the forward PE ratio. To compute this ratio, we take the price and divide it by the estimate of next year's earnings. Using next year's predicted earnings provides us with a more relevant measure. After all, we don't care about the past, we only care about what companies are going to make in the future. However, it does this at a cost of reliability. Next year's earnings are unknown, so these estimates come from financial analysts, or sometimes they come from the CEO of the company. So I think there's value to looking at both the trailing and the forward PE ratios of a company. In fact, for companies with long history of earnings that are very volatile, it may be better just to take a 5-year average. Alright, so let's use our knowledge of PE ratios to compare two competitors, Intel and AMD. So if we look at Intel first, they have a PE ratio based on trailing 12 months of earnings of about 9.12. Their forward PE ratio is 10.82. So their forward ratio is a little bit higher than their trailing ratio, which means they expect their earnings to go down slightly. Nevertheless, PE ratio of 9 or 10 is a very good deal for a company that has been as solid as Intel has. Another interesting way to look at it is what is the PE ratio compared to what it has historically been for this company. Now, you see historically Intel has had a PE ratio of around 14, and right now it's about 9 or 10. That seems like a good deal. Now obviously, you have to take it with a grain of salt. Some things about the company may have changed. It may be at a much greater risk than it has in its history. You have to use your common sense. But overall, taken together, it looks like Intel is a very good deal right now. Okay, next let's look at Intel's competitor, AMD. Their PE ratio is close to 160. Their forward PE ratio is 93. So that lets me know that their earnings are growing pretty quickly here. The major problem with valuing AMD is that they are a very small company in this industry, and you can see their net income over the past 5 years. They've actually had net operating losses for 3 of those years, and only recently have they turned a profit. So while their PE ratio is enormous, just consider how much room they have to grow. With last period's earnings at about $609 million, there is the potential for them to grow greatly in their industry. We can see that by looking at Intel's earnings. So Intel has earnings of about $23.6 billion. So if AMD is able to capture half of that market share eventually, then given their current price-earnings ratio, that could turn out to be an incredible deal. I would caution, though, in this particular situation, it is quite a gamble to bet on AMD. Intel has been around for a long time, and they'll do everything in their power to try to maintain their market share. So I think AMD faces a lot of risks, and there's no certain thing that they're going to eventually be able to capture half the market share in the chip industry. If you like the content so far, please hit the like and subscribe buttons. It helps me a lot. Our final topic is the PEG ratio, which stands for price earnings growth. So this ratio is designed to attempt to overcome one of the limitations of the PE ratio, and that is it's hard to value growth companies with PE ratios. The formula for the PEG ratio is the PE ratio divided by the company's expected growth rate in earnings. So if we look at a company with a PE ratio of 100, it looks very unattractive to invest in. However, if that company's earnings are growing at 25% per year, the PEG ratio is actually equal to 4, which is not so bad. Financial analysts normally estimate the company's expected growth rate over about the next 5 years. Estimates beyond 5 years are really start to get inaccurate. Alright, so let's use our knowledge of PE ratios and PEG ratios to help us value Apple and Microsoft. So when looking at Apple, I see a PE ratio based on trailing 12 months of earnings of close to 36. And their forward PE ratio is about 36, which is not surprising. If you saw my last video, Apple is overvalued because their earnings are really not growing anymore. Let's compare to Microsoft. Microsoft has a PE ratio of about 36, and their forward PE is 32.8. Now, none of these PE ratios are very attractive at all, so I'm going to say that nobody wins on this metric. Notice that if you compare their PE ratios to the sector median, they don't seem so overvalued. This is one approach that some people use to value companies. I'm firmly against this approach because it assumes that the rest of the sector is valued fairly and the company you're looking at may or may not be. That's quite an assumption to make. I think a more likely assessment of the tech industry is that it's really overvalued right now. Now, you can see a real difference between Apple and Microsoft when you use the PEG ratio. I'm going to compute the PEG ratio manually so I can control the inputs. Even though websites like Yahoo Finance will give you their own PEG ratios, you need to read the fine print on those to see what assumptions they're making. So with my PEG ratio, I'm going to look at their net income or their earnings over the past 5 years, and I'm going to use that to estimate a growth rate for the future earnings. So when you look at Apple, using a geometric growth rate, their earnings are really going nowhere. We have a growth rate of about 1.5%. This means that with a PE ratio close to 36 or 37, they're going to end up with a PEG ratio of about 20. Compare that to Microsoft over here, whose earnings have actually grown quite a bit over the past 5 years. Their geometric growth rate average is about 13.6%. Because of this, their PEG ratio is 2.65. Quite a difference. So if you got to choose between Apple and Microsoft, the choice is clear. Go with Microsoft. So what do you guys think? What company are you interested in, and what's their PE ratio? Don't forget to hit like and subscribe. I upload a new video every week.